Let's move and shift focus to the fixed income market. Egie Akpata, head of debt capital markets at UBA, is standing by. Egie, it's great to have you on the show. And let's wrap up this last week. Of course, the previous week was shortened by the holidays. We have a full week to take a look at the bond market and just speak to the kind of volatility we're seeing from where you sit.
Yeah, hi Wole. Thanks for having me on the show. Well, I mean, some of the volatility you've seen on the bond market, even though it's not been extreme, has been really in terms of yields coming down again, and that's been driven largely by the application of the increased weighting of some of these Nigerian government bonds in the JP Morgan index. So you've seen yields on like 2022 come down to 13% with a lot of increased foreign buying. So there's been a bit of movement there. Overall, the market has trended slightly downwards in terms of yields this week.
And the Treasury bill market, of course, we had an auction on the 24th, just before the holidays. How has it traded since then?
Well, I mean, Treasury bill market, no auction this week. Auction is next week. But you did have an OMO auction on the 31st, where the stop rate was 14.05% for 85 days. But when you look at where secondary markets are now, the shorter durations under 60 days are around the 13 area, but the longer duration bonds, I mean T-bills, are well under 13%, like 12.5, even though their effective yield is higher due to the amount of time to maturity.
Well, clearly it's still very attractive yields for those foreign investors. But let's move on to the state bonds. And of course, there's a lot of talk about perhaps we'll see some deals before the end of this year, but I mean, the year is rounding up. We still haven't heard anything. I think we've heard of Rivers, quite a number of other, I think Ekiti also was on that list. What are you hearing about deals in the issuance from the states?
Well, I guess the year is not over yet. We still have like, 58 days or so, 59 days to go. So I wouldn't write off that sector at this stage, even though some of these issues haven't come to the market as quickly as we would have liked. We need to bear in mind that in terms of most of the state issues, this SEC rules on the validity of their accounts effectively means those accounts are valid for 12 months, which means most of them go stale at the end of December. So anybody who needs that money, at least based on the budgets, most of them actually budgeted for significant borrowing from the capital markets. They have to issue this year. If you don't issue this year, you have to do another audit again. Maybe you do a June audit or a December audit, and you're unlikely to be in the market until Q2 next year. So some will come to the market this year. Maybe not as many as we thought it will be, but probably one or two significant ones will come to the market.
In your view, do you think the PFAs will participate in this offers? The pension fund managers, of course.
Yeah, pension fund participation really is a subject of whether those state governments have met certain rules by the pension commission. So if those rules have been met and this pension commission gives a no objection letter in terms of PFAs investing in the offer, then they will buy. The problem has been that most state bond issues have not met those requirements, which is why the pension funds have very little investment in that area.
Okay, and of course, with the power reforms, there's a view that many of these companies that won the bids would have to approach the markets to raise capital. Debt capital, I think, is a likely auction. Your views on whether or not many of them may perhaps begin to issue some of these corporate infrastructure bonds that some people have been talking about for a while. Do you think this is likely, and what do we need to put in place to make sure this happens?
Well, I mean, when you look at the share size of the amount of investment needed for these companies, clearly at some point they'll have to go into the long-term capital market. The question is a matter of timing. The acquisition finance that they need clearly cannot be obtained from that market just because of the amount of time it takes to put together one of these offers. But once they've done the acquisition, there's absolutely no reason why they can't tap the market for either refinancing acquisitions or for expansion capital. Again, a lot of details have to be ironed out in terms of the structure of these companies, the implication of the government holding, and things around their history, because really some of these transactions in terms of the SEC requirements are quite strict, and they will need to prove their financial viability, and that might not be possible on the short term.
I was just going to make that point. Yes, sorry. I was just going to make that point that some of these deals, to begin to issue debt capital, perhaps will be a few months, if not a year down the line, because even at this stage, there's a view that it's not a done deal just yet. A lot of things still have to come together for many of these power companies to get into those power companies. Many of these investors get into the power companies.
It's not a transaction for the next few quarters. But definitely on the medium to long term, that's really the only option they have, given the scale of investment they need. And the money is available. If you look at the portfolios of the pension fund administrators, they can take between 15 and 25%, invest between 15 and 25% of their portfolio in infrastructure bond. So the money is there, it's just that the companies are not ready to take it.